There is a specific kind of financial optimism that only works in your 20s. The optimism that says there is still time. Time to fix the habits that are not quite right. Time to start the retirement contributions you keep pushing back. Time to get the estate plan, the insurance review, the emergency fund, all the things that feel administrative rather than urgent. At 25, that optimism is reasonable. At 35, it is becoming a liability. At 45, it has a cost that can be precisely calculated. 45 is the threshold. Not because anything magical happens at that exact age, but because by that point you have been earning a real income for roughly 2 decades. 2 decades of compounding working either for you or against you, depending on the decisions you made along the way. And the uncomfortable reality is that most Americans arrive at 45 without a clear picture of where they actually stand. They have been earning, they have not been auditing. Today we are going through 7 financial milestones. Not goals, not aspirations, milestones. Specific, measurable thresholds that by 45 you either want to have crossed or need to be on a clear, scheduled path to crossing. Some of these will feel straightforward. At least one will feel like something you have been quietly avoiding for years. Milestone 1. Zero consumer debt except the mortgage. By 45, the only debt remaining on your balance sheet should be your home mortgage, not a car loan, not a credit card balance you have been rolling for years, not student loans from a degree you finished 2 decades ago, just the mortgage and nothing else. The pushback on this is usually that not all debt is created equal, and that is technically accurate. A mortgage on a home with genuine equity, a student loan that produced a measurable return on investment, these are different instruments from a credit card balance accumulating at 22% annually. But the nuance that most financial content leaves unexamined is what American households in their 40s are actually carrying right now. According to Experian, Generation X, the cohort currently occupying the late 30s to mid-50s, carries the highest average consumer debt of any living generation at over $158,000 per household. They also carry the highest average credit card balance at $9,600. In aggregate, Americans in their 40s hold $4.88 trillion in total outstanding debt, the single largest debt burden of any age group in the country. This is a pattern, not an anomaly. And the structural problem it creates is straightforward. Every dollar directed toward interest payments on consumer debt is a dollar that cannot compound. At 45, with 20 years of runway left before traditional retirement, the compounding math is still your most powerful financial tool, but only if you are not spending it servicing obligations on things that have already depreciated or been consumed. A household eliminating $2,000 a month in consumer debt payments and redirecting that amount into a diversified index fund at a historical 7% average annual return accumulates approximately $1 million in additional wealth by 65. The debt was not just expensive, it was structurally blocking the single most effective mechanism available to a 45-year-old investor. Consumer debt at 45 is a fire you left burning. The response is not nuanced. You put it out. Milestone 2. Net worth at the prodigious accumulator threshold. In the early 1990s, economist Thomas Stanley spent years analyzing the financial lives of thousands of American households across every income level. His conclusion, published in The Millionaire Next Door, overturned the common assumption that high earners automatically become wealthy. What he found was the opposite. The highest earners were routinely outperformed in net worth accumulation by moderate earners, who shared one unusual characteristic. They expanded their lifestyle far more slowly than their income. Stanley derived a minimum net worth benchmark from this research. Multiply your age by your annual gross income. Divide by 10. That is your expected minimum net worth at any given point. At 45 and $100,000 annually, the target is $450,000. At 45 and $150,000, it is $675,000. At $200,000, it is $900,000. Stanley called people who met or exceeded this threshold prodigious accumulators of wealth. The contrasting group, high earners with thin net worth, he called underaccumulators of wealth. And the critical finding was that the gap between them had almost nothing to do with how much they made. It had everything to do with how much of what they made they actually kept. The pattern appears with remarkable consistency. High-income households with visible, proportionate consumption, premium vehicles, maximum mortgage, frequent travel, systematically underaccumulate. Moderate income households with deliberate, asymmetric accumulation systematically overaccumulate. often becoming genuinely wealthy on incomes that would not support the image of wealth at all. Calculate the PAW number for your income and your age. Compare it to your actual net worth today. Not what you think it might be, what it actually is. That single comparison reveals more about the trajectory of your financial life than almost any other single data point available to you. Milestone 3. A clear investment strategy you can explain in 3 sentences. Here's a diagnostic question that predicts financial health more reliably than almost any balance sheet figure. Can you describe your investment strategy in plain English, without jargon, in under 3 sentences? What do you own? What is it costing you annually? And why do you own it? Most people with 2 decades of retirement contributions cannot answer those questions with any precision, not because they do not care, but because they set up their 401k allocation in a 20-minute enrollment session at 28 and assumed that a growing balance meant the system was working. At 28, that assumption was relatively harmless. At 45, on a portfolio that has been compounding for 2 decades, it becomes expensive. The expense ratio problem illustrates this precisely. The average actively managed mutual fund charges between 0.5 and 1% annually. A diversified 3-fund index portfolio, domestic equities, international equities, and bonds, runs at approximately 0.04 to 0.7%. On a $500,000 portfolio, the difference of 0.80% equals $4,000 per year in fees extracted silently, regardless of market performance. That $4,000 annual drag, compounded at 7% over 20 years, costs approximately $165,000 in foregone growth. Not from a bad market, not from a financial crisis, from administrative friction in a portfolio the owner never closely examined. The milestone is not a complex strategy. It is a clear one. Take inventory of every account you own, including orphaned 401ks from prior employers that may have been accumulating fees for years without review. Check the expense ratio of every fund you hold and calculate what it costs you annually in actual dollars. Confirm that your asset allocation reflects your age and timeline in 2025, not in 2008 when you enrolled. Consolidate where possible. The goal is a strategy you understand completely, chose deliberately, and could explain to another adult without assistance. Milestone 4. 12 months of emergency reserves. The standard advice is 3 to 6 months of expenses. At 25, that range is defensible. At 45, it is structurally inadequate. The reason the calculus changes is that your financial life at 45 is dramatically more layered than it was at 25. You have a home with maintenance obligations that arrive on their own schedule. You likely have 2 vehicles, which doubles the mechanical failure exposure. You have children who depend on your income continuously, and aging parents who may begin requiring your financial support with no advance notice. And critically, the majority of your accumulated wealth is now illiquid. Your 401k sits behind penalty walls. Your home equity requires a loan product or a sale to access. Your Roth IRA principal is technically reachable, but withdrawing it terminates its compounding function permanently. When an unexpected event hits, and at 45, the probability of a significant unexpected event within the next 12 months is not negligible. You need accessible cash that requires no liquidation, no penalty calculation, and no credit product. 12 months of essential household expenses in a high-yield savings account or money market fund is the target. At the current yield environment of 4 to 4.5% on federally insured cash accounts, this reserve is not idle money. It is a stabilization mechanism that earns a competitive return while eliminating the need for any desperate financial decision under duress. The concrete cost of inadequate reserves is calculable. A $4,000 vehicle repair financed at 22% credit card interest costs approximately $5,000 by payoff. That $1,000 difference is the measurable annual return on having a sufficient emergency fund. The psychological cost of operating without a reserve, making financial decisions under pressure at the worst possible moment, does not appear in any spreadsheet, but consistently produces the worst financial outcomes in every financial difficulty study ever conducted. Milestone 5. An 800-plus credit score. After 2 decades of credit history, a score above 800 is not an ambitious target. It is the natural output of disciplined credit behavior sustained over time. The reason it belongs on this list is that most people in their 40s are not actively maintaining their score, and the cost of that neglect is more concrete than most people realize. Consider a single data point. A credit score of 820 versus a score of 710 on a $300,000 30-year mortgage represents a difference of approximately 1/4 of a percentage point in interest rate. Over the life of that loan, that quarter point costs roughly $15,000 in additional interest, invisible in any single month's payment, devastating in aggregate. The mechanisms of an 800-plus score are not complicated. Payment history is the single largest factor at 35% of the FICO calculation. Automating every bill payment is the single most impactful action available to you. Credit utilization, the percentage of available credit you are actively using, accounts for 30% of the calculation. Keeping reported balances below 10% of total available credit, not 30%, not the limit, 10%, is both achievable and highly impactful. Length of credit history accounts for 15%, which is why closing your oldest open account is one of the most common and costly credit score mistakes. Applying selectively rather than frequently protects the 10% that comes from new credit inquiries. Check your full credit report for errors twice a year. Errors appear more frequently than most people assume and are disproportionately likely to show up as negative items that suppress your score without your knowledge. An 800-plus credit score is not theater. It is a financial asset that saves you money on every debt product you use for the rest of your financial life. Milestone 6. Essential insurance coverage confirmed and calibrated. According to research by the Consumer Bankruptcy Project, 65% of Americans who filed for personal bankruptcy cited medical issues as a contributing factor, not reckless spending, not poor investment decisions, medical events. Health crises that arrived without warning and without a structural response in place. At 45, you have enough accumulated, a home, retirement savings, investment accounts, that an uninsured catastrophic event represents genuine financial destruction rather than temporary setback. 4 categories of coverage require confirmation. Health insurance calibrated to your household's actual medical profile. A high-deductible plan paired with a health savings account is efficient for a healthy household with minimal ongoing needs. A more comprehensive plan is correct for any household with chronic conditions, regular specialist care, or meaningful prescription requirements. Auto insurance with liability limits that reflect your current asset base. The minimum your state requires protects other drivers from uninsured motorists. It was not designed to protect you from a judgment that exceeds your coverage. By 45, the difference between state minimum liability and adequate liability is consistently worth the premium. Homeowners insurance reviewed against the actual current replacement value of your home and the specific risks of your geography. Flood damage is excluded from standard homeowners policies in every state. A standard policy that has not been reviewed since purchase 8 years ago almost certainly no longer reflects what it would actually cost to rebuild. Term life insurance sufficient to cover your mortgage, fund your children's education, and replace your income for 10 to 15 years. If any of those 3 questions produces a no, your current coverage is insufficient. For households with meaningful net worth, a personal umbrella policy adds $1 million in additional liability coverage for approximately $35 a month through most major carriers. The event it protects against is improbable, but financially catastrophic when it occurs. At 45, you have likely accumulated enough that the exposure is real. Milestone 7. A complete estate plan. According to the 2026 Trust and Will Estate Planning Report, 56% of Americans currently have no estate planning documents at all. No will, no trust, no medical power of attorney, no financial power of attorney, nothing. The cohort with the highest rate of non-compliance is precisely the cohort with the most to lose. 62% of Generation X adults, the generation that currently includes most 45-year-olds, have no estate planning documents in place. That rate is higher than Gen Z, higher than millennials, and higher than baby boomers. The generation carrying the mortgages, the retirement accounts, the children, has done less estate planning than the generation that just graduated college. The absence of a plan is not neutral. Dying intestate means a court distributes your assets according to a statutory formula written by legislators who know nothing about your family, your relationships, or your wishes. If you have minor children, a judge who has never met them determines who raises them. If you become incapacitated without a financial power of attorney in place, your family may need to petition a court simply to pay your bills. The minimum documents set for a 45-year-old household, a last will and testament specifying asset distribution, and, where relevant, minor child guardianship. A durable power of attorney for financial decisions. A healthcare directive specifying your medical wishes and designating a healthcare proxy. And updated beneficiary designations on every retirement account, life insurance policy, and bank account that permits them. These designations typically override whatever your will says, which means an estate plan that overlooks them can still distribute assets contrary to your stated wishes. If your estate includes meaningful assets and minor children, a revocable living trust allows your estate to bypass probate entirely, meaning less time, substantially lower cost, and dramatically less complexity for the people you leave behind at the worst possible moment in their lives. The financial commitment for a comprehensive estate plan through an estate attorney runs approximately $1,500 to $3,500. The cost of not having one, measured in legal fees, court-imposed delays, asset distribution errors, and family conflict during a period of maximum grief, consistently exceeds that figure by an order of magnitude. 27% of Americans have never discussed their end-of-life financial wishes with anyone close to them. The plan only works if the people who need to act on it know it exists. This is the 45-year-old financial diagnostic. 7 thresholds, 7 questions to answer honestly against your actual numbers, not against what you think you might have or what you hope the figure is. 0 consumer debt outside the mortgage. Net worth at or above the prodigious accumulator threshold for your age and income. A clear, cost-efficient investment strategy you can articulate in 3 sentences. 12 months of essential expenses in liquid reserves. A credit score above 800. Insurance coverage calibrated to what you have actually accumulated. And an estate plan that functions as an operating system for everything you have built. Understanding money is your best defense.